Hey everyone, it's Imran from Options Insight, back with your macro options spotlight for today.
Remember, like, subscribe, comment. I want as many questions as you can possibly think of about options.
Okay, strong day for markets in the US, continuing on from that rally late Friday. Tech really leading the way as the market, starts to get a bit more optimistic about these earnings reports coming out of the tech space. We obviously had Netflix rallying. We've got Microsoft tonight. Europe and Asia, on the other hand, lagging a bit. Obviously, they had a stellar start to the year, outperforming, but all of a sudden, the US market's coming back with a bit of vengeance. And we're getting a mini rotation away from value back towards growth. We'd obviously been talking about the whole Dow Jones versus NASDAQ outperformance and thinking that the NASDAQ might have its revenge. Well, we started to see that over the last few days. Let's see if it can get some legs. I'm not doing a victory lap on it just yet, but we are starting to see it move that way at the moment, in the near term at least. In commodities, silver got hit about 5% intraday, but did recover half the drop, closing only down around 2%. And then nat gas finally having a bit of a bounce, a rare rally of 7% on the day, but it was beaten up, coming from pretty oversold levels. So I wouldn't read too much into it. Still think nat gas has got quite a lot of pressure coming for the coming months. Okay, vol-wise, US vol's pretty muted. We did see a bit of selling pressure on European vols, where the realized does remain a bit more subdued. And then commodity vols continue to drift, as we have been seeing positive carry in commodities for a while now. And unless we get some real spicy realized coming out of some of these commodity names, and we get some red coming on the carry board, then these vols are going to continue to drift lower. And then skew-wise, we had said we saw a bit of a rally in skew, particularly in US indices last week, giving some back there, down nearly a vol point across NASDAQ and Russell skew. And that's just giving a bit back from that bid. We do think vol traders will see a bid in skew as an opportunity to fade unless we see some material downside in stocks, and also material downside coupled with a bid to volatility. And that's something we haven't seen for quite some time. And I think we would need to break some serious levels to the downside. And you'd need investors to be much less underweight than they currently are to induce a bit more panic to the downside. And I think we're a good few months away from that. What else am I looking at? So Deutsche Bank and Goldman's, few notes out from them, few charts out from them to try and talk about this rally. So Deutsche is saying that equity positioning, according to them, and they consolidate various things that they look at, is still looking pretty light. 16th percentile leaves room for quite a lot of chasing if this market continues to rally. And it does seem like we are already seeing CTAs getting forced back into the market as spot breaks above key downtrend, builds some momentum, breaks above that 200-day moving average. So we are seeing CTAs address some of those shorts, and we think that continues if we were to pop above to 4,100 on the S&P. Also worth considering what Goldman Sachs have been saying, chart on the right, where they've seen equity mutual fund inflows, and they look back at data back to 96. And generally, January tends to be one of the big months where they do put a lot of money into those equity mutual funds. So the idea is 134% of the flows that you expect to see into equity mutual funds happen in January. So there tend to be more inflows in January than the whole of the rest of the year combined. So don't be surprised if we see a bit of an underlying bid to stocks as people put money to work in Jan. So we've already talked about that, but that's being confirmed by the data that Goldman's are putting out there. And then just add to that cocktail, realized vols coming down, which tends to drive vol control players back into equity length. We've got corporate buybacks restarting in the next week or so. And so therefore the hurdle to take markets lower is getting higher and higher as more of this kind of price insensitive buying is going to come back, basically. We've said we favor a period of market strength potentially into March as more money gets forced back into stocks. And then we'll see this wake-up call potentially coming early summer when the Fed pivot that is priced into rates doesn't materialize as planned, and markets may need a knee-jerk repricing lower once they cotton onto that, if that's the way it's going to play out. And that's what I suspect is probably going to happen. Okay, if we look at what to do trade-wise. So obviously, I've been talking quite a lot of bullish ideas recently, whether it's in stocks or commodities. So it's worth bearing in mind that whilst I do tactically believe we're going to get a short-term move into March, probably to the upside as this kind of downtrend resistance is getting taken out. And it's not completely convincing just yet. It's like threatening to take it out here. But it is above the 200-day moving average. And, you know, if we were to close above, say, 40.50 this week, then you could probably say, yeah, that level's been taken out. But what I've got here on the chart has got March OPEX. And I don't think we're going to get material downside below this 37.50 area until after March OPEX, because that's when those big FOMC meetings start to come in, where we might see a material change, right? If we look at the February FOMC, it's priced 99% to do a 25 bip hike. There's very little uncertainty there. March, however, is priced at 85% to do a 25 bip hike. But we're going to find out a lot more information in March, where they're going to give their projections and their dots, etc. So that there is arguably going to be much more to glean from that meeting, and that might induce more volatility. And then the meetings after that, we're having early May and middle of June, they could be volatility inducing. So I think any material downside in equities is likely to happen after March OPEX, and kind of between then and June, where we may then get to this potential target of 3,200 if that's the way things are going to play out. Okay, so what would I do if I was looking for protection, if I'm looking for some downside convexity in the book, because I am medium term still quite bearish, and what if I'm wrong about this short-term rally and we actually do just roll over on the back of whether it's an earnings recession that people start to price in or not? What could you do to have something in the book that does okay to the downside? So that's what I've been thinking about, and I've kind of landed on the idea of downside put calendars, where you sell March puts and you buy June puts. In terms of the specifics of what I think makes sense, if we look at the volatility dashboard, obviously buying puts is screening well, but that's just because we've had a bit of a rally recently, and vols have been coming cheaper. But if we look at the term structure, that's the green line here. We see March vol here. June vol doesn't look materially more expensive. So for me, the term structure is quite flat. So when the term structure is quite flat, I like the idea of buying calendars and buying the options in the longer maturities to sell the shorter maturities, right? So that kind of sets up nicely a flat term structure for my put calendar idea. If we look at skew, we can see that we've got skew's been trending down for a while. Obviously, the front end's had a bit of a pop, but you look at the 90-day skew, look at the more medium-term skew, it's still very much towards the lower end of the range. So if we're going to buy puts in June, we're going to like the fact that downside skew is quite flat in that more medium-term part of the curve. Okay, so those are kind of things we're being pushed towards. In terms of the trade specifics that looked interesting to me, this trade looks very similar to something that I suggested in China on the upside. This time we're looking at it on the downside, and we're doing it on S&P. Okay, remember, feel free to ask me any questions about this structure or anything that I talk about in the videos in the comments, and I'll catch you all tomorrow. Thanks a lot.